Navitas Semiconductor stock is officially closed for the day on May 26, 2026 at 4 p.m. Eastern Time, sitting at a price of $31.79 per share, marking a significant intraday increase of 8.68% as buyers stepped into the market with notable strength. While most investors looking at microcap and mid-cap technology names are obsessing over mainstream silicon providers, the actual shift is happening in wide-bandgap materials, where this specific player has quietly decoupled from its traditional dependence on consumer electronics. The real surprise that the market hasn't fully priced in isn't just the current double-digit sequential revenue growth, but the aggressive restructuring of their entire operational focus toward high-voltage systems that completely bypasses the legacy mobile charging market. The common view among retail traders using standard software or checking basic watch lists is that this company is just an unprofitable, volatile semiconductor play that moves entirely on speculative retail volume. People look at a net loss and think it is too risky to touch, assuming that smaller chip firms will inevitably get crushed by giants. But the reality is, institutional capital has begun accumulating shares because of a massive transformation in how power is managed in back-end infrastructure. Instead of fighting for a spot inside consumer hardware, the focus has shifted entirely to the infrastructure that feeds those systems, meaning the underlying investment thesis has changed from a low-margin hardware play into a critical component of data architecture. If you pull up your charts on a modern online investing app or analyze institutional holdings on popular platforms, the recent price action tells a story of extreme accumulation. We are seeing trading volumes that heavily exceed the historical daily averages, showing that large blocks of shares are changing hands. This usually points to hedge funds and asset managers building positions rather than short-term retail day trading. The stock has experienced wide swings over the past year, reflecting the tension between old backward-looking financial statements and the forward-looking reality of their order pipeline. When the broader tech sector faces macroeconomic headwinds or interest rate pressures, smaller companies usually take the hardest hit, yet this specific asset has shown a strong relative strength index, finding a solid floor and bouncing back aggressively. This indicates that the market is beginning to value the company based on its asset base and its intellectual property, rather than its trailing 12-month losses. For anyone managing an individual brokerage account or using an automated platform like Schwab Intelligent Portfolios to balance their tech exposure, understanding this volatility is key. This isn't a stock that moves in a smooth line. It reacts violently to sector momentum and updates from large infrastructure clients. Institutional activity has become the primary driver of these daily swings, and watching the order flow reveals that large block trades are setting the tone during morning sessions. When a company manages to beat top-line revenue forecasts, even by a small margin, it signals to Wall Street that the worst of the cyclical semiconductor downturn is behind it. The broader sector has been dealing with inventory corrections for quarters, but the demand for high-efficiency power management has created a completely separate demand curve that is keeping this company insulated from the broader consumer slowdown. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio right now. Looking at the core business model, this company operates as a pure-play designer of next-generation power semiconductors, specifically focusing on gallium nitride and silicon carbide technologies. Instead of using traditional silicon, which has reached its physical limits in terms of efficiency and thermal management, these alternative materials allow power systems to run much faster, cooler, and at significantly higher voltages. The business model relies on a fabless approach, meaning they handle the complex intellectual property, design, and architecture, while outsourcing the capital-intensive manufacturing to major global foundries. This keeps their balance sheet relatively light on heavy equipment costs, allowing them to pivot quickly when technology requirements shift. Historically, their revenue was heavily tied to fast chargers for smartphones and laptops, which explained the massive revenue drop when global consumer spending slowed down a couple of years ago. However, the recent financial reports show a deliberate and rapid pivot toward what management calls high-power markets. This includes hardware for data facilities, industrial equipment, crate infrastructure, and renewable energy storage. By moving away from low-margin consumer electronics, the company is actively expanding its gross margins, which is exactly why the stock has been seeing this newfound institutional support. Their latest quarterly earnings revealed a sequential revenue increase to $8.6 million, and while that might sound small compared to mega-cap chip makers, the underlying gross margins on a non-GAAP basis held firm at 39%. This margin stability during a major orbit transition proves that their high-voltage solutions command premium pricing power in the open market, giving them a clear path toward operational profitability as their shipping volume scales up over the next few quarters. When you look at the landscape of online investment platforms today, whether you're browsing tools on Interactive Brokers or checking asset allocations on SoFi Invest, it is clear that investors are hunting for hidden suppliers to the data infrastructure boom. Everyone knows who makes the primary processors, but fewer people think about the massive amount of electricity required to keep those processors running without melting the facility. This is where gallium nitride and silicon carbide come into play. Traditional power delivery systems lose a massive percentage of electricity to heat, requiring even more energy for air conditioning and cooling systems. By implementing wide-bandgap materials, operators can compress the physical size of power delivery boards while running them at higher efficiencies, directly lowering the total cost of ownership for massive computing clusters. The future outlook for this asset depends entirely on the tension between execution speed and cash burn. The company is currently sitting over $220 million in cash and equivalents, giving them a significant runway to scale their operations without needing to dilute shareholders with immediate secondary offerings. The biggest catalyst on the horizon is the commercial adoption of their newly developed 800-volt power delivery boards, which were recently showcased at major industry events. If these systems get integrated into the reference designs of major cloud service providers, the revenue pipeline could scale exponentially, completely altering the financial profile of the firm. The primary risk factor remains the intense competition from legacy semiconductor giants, who are also building out their own internal wide-bandgap divisions. If larger competitors with massive capital budgets begin slashing prices to protect their market share, smaller firms could see their margin expansion stall out. Furthermore, since the company relies on third-party foundries for its physical production, any geopolitical disruption or supply chain bottleneck could delay shipments and hurt quarterly results. Investors need to monitor whether the company can maintain its current margin advantage as production volume scales up throughout the rest of the year. Evaluating this asset requires looking past the historical financial losses and focusing heavily on the structural shift in their revenue mix. The market expectation was that this company would struggle to survive the consumer electronics downturn, leaving it as a distressed asset with falling revenues. The reality is that their strategic pivot into infrastructure and high-voltage applications has successfully stabilized their margins and returned the company to top-line sequential growth. This massive gap between what the average retail investor expects and what the institutional data shows is exactly what is driving the recent high-volume accumulation and the strong upward move in the stock price. For anyone managing their own capital across various investing sites or active trading platforms, keeping a close eye on these small-scale infrastructure suppliers is becoming a necessary component of tech sector analysis. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, subscribe for more updates.